Earnings season is underway, and I'm back on the desk, but for only one day, just in from the money show in Las Vegas, and then I am heading out this afternoon. But I'm going to take your questions today on Open Mic. Hello everybody and welcome to Open Mic on the Open Interest YouTube channel. I have been gone for a little while, as you guys have probably noticed. We did a couple of the Open Mics from the East Coast, the sweltering heat of the New York City area. I am back in Northern California, having gotten in around 10 p.m. last night from Las Vegas, where it wasn't too cool either, but it wasn't as humid. And I am actually heading out again later today, and we'll be out until Sunday. So we are going to try to do office hours on Friday with Professor Mark Guthner, assuming he is available from wherever I am, which is probably either going to be Los Angeles or San Diego. I'm not 100% sure which place I'm going to be in at that particular hour, but be sure to check back to see whether we're going to be doing that live. So because I've been out for so long, and I thought there might be a couple more questions, or maybe not, because we missed Monday's live stream. I thought I would address, we have a couple earnings coming up, not least of which is going to be Netflix tomorrow, which I think is kind of interesting. Oh yeah, I see a couple questions here. So let's just talk a little bit about Netflix and what we're seeing there. So I have repeatedly described, you can see actually, if you're looking at my screens, you can tell that I was actually looking at Netflix during the day today. So right now the options market is implying a move of about 6.6% or so by the end of this week. 6.5% is theoretically the one-day earnings-related implied move, but since they report tomorrow after the close, there's really only one trading day left. I mean, effectively it's the same thing. The historical move has been a little bit higher, but we covered it pretty extensively ahead of Good Friday when they were reporting that last quarterly earnings release, which took place very strangely on the last trading day of the week, which was also going to correspond to what turned out to be regular way April options expiration, just because of the way the calendar worked out and when Good Friday fell. So I actually think that the move that we saw last quarter might have been a little bit more muted because of that. The market had an opportunity, number one, to digest the information over three vacation days, effectively, because of the long weekend. There was not going to be a lot of volatility associated with any expiring options, because all of the options had expired prior to the earnings release, just because of that weird sort of anomaly that we had with respect to the earnings release. So that 1.5% move, I'm kind of discarding that. The actual average over the last 8 quarters, then if we exclude that one, is closer to 9%. And if you're looking at my screen right now, you can actually see what some of those look like. Now, there's something else that I think is worth looking at, and that is that the expectations are quite ambitious, right? So what we're seeing is that the expectation for the year-on-year quarterly adjusted EPS of 7.25 is a year-on-year increase of almost 51%. And to put things in perspective, the last time they had a Q2 earnings release, their year-on-year improvement was only 43%. And I do see that's possible, even though that would be one of the better year-on-year improvements. And you might be thinking to yourself, how is it possible that a mature company like Netflix could actually be growing their adjusted EPS at a faster rate than they were historically? So I'll share my thoughts on that, but then I also want to point out that I think a couple key tailwinds are at the very least slowing down a little bit. So first of all, why would adjusted EPS actually accelerate? We know that the company did a couple of things which were very positive on the revenue side. One was that they were cracking down on shared user IDs. So that essentially reinvigorated subscriber growth. And the second is they ended up with this, two-way model where you could have advertising as well as an ad-free environment. So basically this tiered payment structure. Both of these seem to have been a good decision. And it also seems to me that to the extent that they were well in the lead of competitors like Disney and Paramount, I now kind of am viewing Disney and Paramount as they're just not really in the mix. Now, part of this is driven, admittedly, by my own experience. We had subscribed to Paramount here. We had subscribed to Disney Plus here. We are Amazon Prime folks. In our household, we're basically using Netflix and Prime Video at this point. Rarely use these others. I'm also a YouTube TV subscriber, and that's just because for sports, if any of you use that, you probably know just how great that is. You can watch 4 games at once, and you can have some or all of the audio going. It's awesome. And when I look at that, I think, boy, these other players are just out of the game. So what ends up happening is, you'll remember that in the early days, even as their subscriber growth was phenomenal, they didn't have such spectacular free cash flow. Let's go back a whole bunch of years. Hopefully you guys can see this. I'm going to scroll down. So I'm going to go back a number of years here. And you can see down, that's the bottom line. So hopefully you can make that out. So down where my cursor is, yep, you can see that. Okay. Negative free cash flow, basically investing in the company's future growth. This was something that you often see in growing businesses. In the case of Netflix, the bear's case for Netflix was generally that content costs were going to eat them alive. And they were going to be aggregating all of this content, but there was this sense that they were never going to be able to get ahead of that, and it was just going to be this big negative free cash flow thing. Well, fast forward to the present day, and 2 things have happened. One of those is that they're the 800-pound gorilla. They are creating their own content. They kind of get to dictate, what's going to, how this whole thing's going to go. And of course, they've turned cash flow positive. And when you get into that environment, when you start to see the benefits of all of that early investment, that's when you do start to see net income margin expansion. So we kind of think as businesses mature and the top line growth slows, that their earnings growth is going to slow. In fact, the opposite can happen, because you've kind of gotten to that point where you've put all of the Lego blocks in their appropriate places, and now you can sort of turn on the free cash flow knob, you can turn on the EPS knob, you can turn up the margins just a little bit. Same thing we saw with Amazon. The thing is that I'm trying to figure out what that next top line tailwind will be. So remember what I was just talking about. Just cracking down on user ID sharing, multiple tiered model and advertising revenues. So, do I think they can hit this number? I do. And actually, I rather expect them to. But I want to just show you this one thing here, which is that, if we take a look at their multiple, I'm going to get rid of the price because we really want to think about what we're paying for a business based on what we're paying for forward earnings. You can see we're creeping right back up in there, right, in terms of the multiples. And if we take a look back here, the last time we got to this turn on forward earnings, so we're just going to draw that over here, right? So this is where we are right now on the earnings front. That's these yellow bars. And this was the price action. Now, 2022 was a rising rate environment. It doesn't look like we're in a rising rate environment at the moment. And I'm a little bit concerned, to be honest, because we've got President Trump continuing to pound the table about how Powell's doing a bad job. And the fact is, I really want to see monetary policy utterly divorced from any other, from any branch of government, frankly. There's no reason for politicians to, they're going to debase the currency anyway, because they're going to borrow money with impunity, and they have done. We don't need them to aggravate the situation by keeping rates low. All right, so bearing all of that in mind, if you have a position in Netflix going into the print, we don't get to play those kind of cool games like we did the last time, because we were going to play off of the open interest and the fact that people might not realize that they had an opportunity to exercise options that would prove to be in the money after the earnings release came out. But the fact is that the price of options right now is fairly reasonable going into the print. So if you own the stock, not a terrible idea, in my view, to consider putting on maybe a put spread. I don't know that you need to buy outright puts, but a put spread might not be a bad idea in here, just because we are getting to the upper boundary of the forward earnings multiple. So we can come up with an example of that. And the other thing I would say is that if you don't have a position and you are bullish, very reasonably priced options. And in fact, we actually saw a pretty good sized bullish bet. So calls outpaced puts today. It was the July regular way calls that were the most active today. And let me just see here. I'm going to see how many ultimately ended up trading. Let's just take a quick peek here. But somebody laid out a decent amount of premium. It was on, was it the July 1260s? I think it was. Let me see here. Quickly pull this up. I saw a 300 lot trade at 42 bucks early. Oh, look at that. Yep. And then we had some spreads going on. But this was the first one right off, pretty much right after the open, about 18 minutes after the open. Somebody paid 42 bucks for 300 of these. Not a modest options trade when you think about it. 300 contracts doesn't sound like a lot. And, you know, $42 as a function of the current $1,250 stock price. Again, that doesn't sound like a lot. But that's more than $1.25 million in premium that expires the day after tomorrow. So that's not modest. You're talking about 30,000 shares of a $1,250 stock. In this case, $1,260. The stock was a little bit higher when this went off, but my point is, you know, you're going to be risking a relatively small amount to make a bullish bet in that case. Short dated trade, fair enough. You know, maybe you might want to take a look at a spread. It looks like somebody else was trading spreads in here, so we can see that there was another 1,000 or so. I'm assuming it was 1,000 because these are consecutive prints, and there was probably a lot more trades in here. But it looks like somebody bought 1,000 call spreads as well. So let's get back to those put spreads first. If you happen to be long the stock, not going to cost you much to make a bearish bet in here. So we'll just put this in. And I don't even mind the idea of going out an extra week, sort of let the market digest it, because one day, if it does prove to be weak, it wouldn't surprise me if you get a couple more days of pressure. Remember that institutional holders, that's one of the reasons we have this 3-day rule, is that once they start to make moves, they can't do everything all at once, and there could potentially be a little bit of follow through. So no reason not to even consider going out to the 25th. Again, options prices are very reasonable here. Maybe something like a 12.25. Doesn't have to be something too outrageous. Let's take a look at how the 12.25. And it also, if you don't have a position in the stock, don't be concerned about potentially tightening up that spread so you don't have to lay out a lot of premium. I mean, if you have 100 shares of Netflix, it's $125,000 in one position. My former boss from the hedge fund where I used to work, this is actually his biggest position, and he's got millions of dollars worth of it. But I can understand why a lot of people might not. It's a chunky, high dollar stock, so having hundreds or even thousands of shares of it, probably for most retail investors, is pretty uncommon. And if you do, unless you have a pretty big account, that might be excess concentration. So, in my former boss's case, 9-figure account, he can have $5 million worth of Netflix, and it's not excess concentration. But I don't encourage that. I only bring this up because yesterday when I was at the Money Show in Las Vegas, I was talking to some self-directed investors, and there was a guy there who said he started last year with $1 million in his account, and he has $4.5 million in his account now. But he was asking me how he could avoid a mistake that he made earlier this year. He decided to travel to China for the months of April and May. And so Liberation Day happened and stocks got hit. And he said he ended up getting blown out of some NVDA calls that he had. And I asked him, how many NVIDIA calls did you have? And he said 500. I said, 500? 500 calls. And I said, what expiration? He said, July. 500 calls for a retail account in NVIDIA, that's pretty chunky. I kind of told him, I said, you know, not for nothing, but I think you're taking a little bit more risk than you probably should. Now, how can I fault the guy? He made $3.5 million in trading profits on trading options on $1 million in capital in 2024. Well, I didn't have those kinds of returns, but anyway, that's not the kind of thing we typically recommend here. You know, live to play another day is the attitude. So that's one thing you could do, or you could just buy like those 1260 calls that expire at the end of the week. They are, you know, trading $36, I think, as of the close. So, you know, versus stock, like I said, was a little bit lower. So, you know, it's less than 3% of the current stock price. You know, so you're looking at about a little over a 3% upside break even. Okay, so let's take a couple of questions and move on. So, Kirk Mazie, you said NVIDIA exhaustion of buyers at the 167 level, August 29th, 160, 150 put vertical after earnings date. Yeah, I like that trade. Look, it's been so much good news. What do we have? The hyperscalers all basically saying we're going to invest more money. Everybody with big checkbooks is saying we're paying huge amounts to invest in the space. Now the H20s are going to be available in China, which is huge. And it was huge for AMD too, because they are now going to be offering, you know, one of their chips that they hadn't previously been selling to China. And here's a question I would have for all of you, just something to think about. If Chinese AI companies are now able to buy H20s and anything in the catalog from AMD, and they've got deep pockets that start spending big, what does that do to Western AI investment in the space? Does it go up or does it go down? And I would argue that there's just no way you can look at this and think anything but if you are competing with them, that you have to redouble your efforts. So it's certainly not going to cut CapEx. That's the positive. But the flip side, I think, Kirk, this is partially to your point. So if we're going to ignore just the technical exhaustion factor, $4 trillion is a big, big number. To squeeze another 25% out of this thing right here is to add $1 trillion worth of market cap. Now, if there was ever a company that justified it, NVIDIA is it. But it's asking a heck of a lot. Let's actually take a look at something on this front as well. I just want to take a look at this, because this was a point I was making to the folks. I think we've talked about it a little bit, but I might as well just come back to it real quick. I was pointing out that because we're not in a zero interest rate environment, when rates go up, it increases the value of calls, it decreases the value of puts. And I was showing that a zero-cost put spread collar on the S&P that lasts 6 months has 14% worth of upside and 14% worth of downside protection in a zero-rate environment, but 16% worth of upside participation and 16% worth of downside protection in the current, 4 to 4.5% interest rate environment. So if we take a look at this in NVIDIA and you say, okay, well, I think we're kind of getting to a point now where might be running out of gas. So what do you potentially do? Let's say you're going to look at, say, a 165. I'm going to push this out in time. Let's go out in time here. Let's just go all the way out to January. So you buy a 165 put, and you want to sell a Jan call and sell a further out of the money Jan put. And this is just so that you can push it into the, potentially into the next tax year. I'm not giving tax advice. Important point, by the way, this is also true for Netflix. Check with your tax attorney or your accountant or whatever. But I will say that from my own experience, I do know that you can change the... you may end up changing what a long-term hold into a short-term hold if you implement a hedge on the underlying equity. So if you have held NVIDIA for a long time, or in our pre-existing case you were talking about Netflix, again, this you need to double-check on this yourself, but I'm just telling you from my own experience that if you buy puts on a stock, it doesn't necessarily mean that if you monetize those puts that you're going to have a taxable event in the underlying stock if you don't transact in it. But it can actually change the holding period it can reset the holding period effectively, and that has its own implications. So just something to think about there. Okay, so let's just take a look at this for a second and see where this gets us. We want to sell an upside call. What we're looking for is something to offset the cost of this put. So, you know, maybe you want to sell something that gets you about $7.5, $7. Let's just go down to the 140s, and let's go up here. We're going to look for something that's also about $7, like that. Go like this. Okay. And here we are. Okay. So now you get protection, you know, $25 worth of protection, pretty meaningful. Now you're going to see there's a slight outlay for this trade to do this. You still get big upside. I actually wonder whether you need that much upside. Let's just say that you think, okay, so the stock's trading 171, and this is only for 6 months, right? 6 months trade. How much more could there be in it? But let's just say, what, 25, 170. Yeah, so I mean, you're looking at almost, you're better than 20% upside to the 210s. And don't forget that the wing options are going to decay a little bit more rapidly. So I was just pointing out that the higher interest rate environment, because it's increasing the value of longer dated calls and decreasing the value of longer dated puts, is getting a little bit better. Kirk also making the point that Palantir's on a tear, right? Yeah, I mean, a lot of these, a lot of the high flying stocks, I'm not 100% sure how much more we can squeeze out of them. Let me show you something else, because I was looking actually at the NVIDIA and also the net. So in Netflix's case, I was just taking a look at where this thing was relative to a longer moving average. In my case, just habit, probably introduced by my friend and technician extraordinaire Carter Worth. I was just making the observation that this thing was getting, like, how far it is above the 150-day just started also to feel a little, so it wasn't just a valuation thing, just feels like there's a lot of exuberance. We can see that we're getting, you know, that gap is sort of spread out a little bit. So something else to think about. All right then, FinWest, good morning, Mike. How are you liking the start of the earnings season? So I think I had the earnings here we are. The earnings season, we're really early, right? So normally I think of JP Morgan as being the kickoff. Really, it's Delta, I guess. So I just went back to that Monday right before Delta. Delta reported on the 10th, so I just went back to the 7th. And, you know, out of, you know, call it the top 3,000 U.S. stocks, only 61 have reported. The earnings surprise, you know, generally earnings surprise, this is a really small sample, but the earnings surprises are generally good. So we're seeing adjusted EPS at about 8.5% better, which is in line or better than sort of historical averages. Sales surprises also good on a net basis. So far so good. But it's, like I say, it's a pretty, it's a pretty big, you know, a pretty big number of earnings to go, and a very few have reported. So I don't know whether we can extrapolate much from that, but yeah. So let's see here. Monday morning quarterback. After meeting with the MSTY group, yeah. So that's right. I was in New York. I met with the YieldMax team. In fact, actually, they had a bell ringing ceremony at the Nasdaq last Friday, the Nasdaq Stock Exchange, and I joined them for that. So I was there with the company CEO. They had a lot of employees there. I mean, they must have brought at least 25 or 30 employees. They had traders in from Chicago. They were operating a temporary trading desk in New York, so I went and visited those guys. Many of them have backgrounds not dissimilar to my own. Former options market makers, vol traders, DPMs. I was not a DPM, I was a specialist. It's basically the same thing. That a SIBO DPM is kind of similar to a PHLX, Amex, or New York Stock Exchange specialist, which was a role that I had for a couple of years. Good guys, you know, thoughtful, entrepreneurial. And yeah, so I like them. I think I'm going to be talking to them again tomorrow about some stuff. So I like those guys. And it's interesting because one of the questions I got, actually, I think I was at at the Money Show. Somebody was asking me, and I believe it was about this one, about the yeah, that's right. It was Tesla. It was the Tesla YieldMax strategy, and they were saying, oh, well, you know, the thing is, you know, the stock's down a whole lot. And I said, well, look, the issue that you have is that Tesla hasn't been doing so great. So don't forget, if you do a buy right, you're selling puts. If you sell puts and the stock goes down, that's not, you know, that's not the outcome you want. You know, the best possible outcome for a strategy like this is that it's mildly bullish, you know, neutral to mildly bullish. That's when you want to be in a situation like this. If a stock's just going down, you know, it's not going to be a great environment for that. So let's just take a look at the past year or so. Let's go back to July. So on the other thing I was going to say is that if this thing is chopping around a whole bunch because you're short vol, imagine if you're selling straddles. Is this the stock you want to sell straddles in? Right? You want to be short vol in? Probably not. You want something that's just a nice, slow and steady grind. So when you're looking at these strategies, one of the things you want to be taking a look at as well is take a look at, is the price in here? We don't want that. What you want to do is you want to compare the historical vol, so the realized volatility, to the implied volatility, because effectively one way to think about what's going on is you are, you know, if you're going to be in this trade, you are selling the realized vol effectively. That's what you get. So if you take a look at this situation, one of the things you're going to notice, as you can see, that the realized volatility in Tesla has been, now that doesn't necessarily mean that will always be the case, so you kind of have to make that judgment. But you're going to notice that the realized volatility, I'm going to draw the 0 line in here. Okay. So when this is above 0, good to be short options. When this is below 0, not so great. And I think we can see over the course of the last 2 years, in Tesla at least, pretty tough environment to be short vol. And this makes good sense. Who 2 years ago thought that Elon Musk was going to get involved with the election, that he was going to join the administration, that he was then going to get into a fight with the administration and then make up with the administration, then go back and start fighting with them again? I mean, you get a lot of surprises out of Elon Musk and out of Tesla, but I don't think this was really on a lot of people's radars back in, you know, 2022 and early 2023. I think certainly by the time he was showing up on the Joe Rogan podcast and saying, you know, I think this is an existential crisis, I think at that point you have to sort of say, okay, well, this is gonna chop the stock up a little bit, and it is still. Do I necessarily, you know, I'm not going to fault a guy for expressing his political views, and actually, given the risks he's taking by doing so, whether you agree with him or not, you have to admit it takes some guts to do that. And, you know, people should stand up for the things they believe. But if you're a Tesla shareholder, or if you've been short Tesla options, it's a tough go, right? Okay, so let's see here. InvestWise. And oh yeah, one last thing about MSTY. So the interesting thing about MSTY, of course, is that Michael Saylor is short vol on Bitcoin. MSTY is short vol on MicroStrategy, but they're being a little bit clever about owning a little bit of upside calls. So they have kind of a kicker participation on the upside there, which I think is kind of interesting. So again, they're trying to be thoughtful about it, and I like that. Okay, and like I said, I'm having another conversation with them tomorrow, so more to follow on that. Okay, what do we have here? Hello, I have a deep in the money naked. Ooh. I have a deep in the money naked short call on coin at 290. Is there any strategy that can help me along with rolling it out? And I rolled it out once and it turned out to be very costly. Okay, so a couple things about this. On single stocks, this isn't going to help you, but maybe it will help you. Maybe it'll help others. I don't sell naked calls on single stocks. I am happy to sell covered calls, and I am okay selling naked calls on an index, especially a cash settled one. You know, market can rip, and then you just face the music, just like you would a swap. You have to pay it out, and that's fine. And the reason is because there's just too much idiosyncratic risk. You can get a squeeze situation if it's a short, you know, if it's a heavily shorted stock, and a squeeze situation can be very ugly, and you can get buyouts, right? So I've certainly seen situations like that. We were actually the market makers in JP Morgan back in the day, before it merged with Chase. So we actually had market makers in Chase and market makers in JP Morgan. And there was some issue about whether JP Morgan was going to get acquired. I think the rumor was at the time that they were going to get acquired by Chase. Now, I'm not even sure which way it went, who acquired who. I believe it was JP Morgan took Chase over, not the other way around. But in any case, it's a difficult situation. And just to add another anecdote to this, a friend of ours here in Northern California who had employed an advisor who was running covered call strategies on some of his core holdings, many of which included names like NVDA and Tesla. He had a lot of tech stocks. He's not really uncommon for this area. You know, people see the Silicon Valley folks doing well. They like to buy stocks in those companies. And he had asked me to review his account. And I said, sure, I'll take a look at it. As a courtesy, I didn't think it was going to lead anywhere. I never gave it any thought. And I started to look at what was going on, and I saw that he was short some really deep in the money calls in a lot of these stocks. And in many cases, they were very long dated as well. And what I discerned had happened was that the advisor had promised him that he was never going to have to sell his stocks. Now, you're naked short calls, but the same thing applies. What they were doing was every single time they thought they were going to get assigned, they would simply find a call that had at least as much premium and sell that so they could buy back the shorter dated one. And as the stocks got higher and higher, these things were getting deeper and deeper in the money. And eventually what ends up happening actually is that there's almost no extrinsic premium in these options at all. And I really just it's a situation that can turn out very, very badly because stocks, I mean, in theory they can go to infinity. They don't really go to infinity, but my point is that I've seen people who shorted Netflix many, many years ago. It was one of the hardest. I knew a institutional firm, this family office in Texas, and it's been enough years now that it probably won't matter that I mention this. But they lost $250 million short Netflix. And it can really get very, very ugly. So my suggestion is in these cases that you probably kind of want to take your medicine, or at the very least, if you want to press a bearish position, use short call spreads. Define your risk. And I want to say one other thing, which is that my year-end price target for Bitcoin was 150,000, and coin isn't Bitcoin, but if Bitcoin goes over 150,000, I kind of think that coin's going higher. Just because I happen to think Bitcoin's going higher, that doesn't mean that it necessarily will. But I wouldn't be short upside in this complex. I would not be short anything in this complex when you have the President of the United States suggesting that we should have the lowest interest rates in the world. we're running a $2 trillion deficit. We've had huge monetary debasement over the last several years. And, you know, to have both the Fed, we've seen situations before where the Fed has acted at the behest of the executive branch. It happened at the same time that you had policies going into effect that were not going to be supportive of the dollar. So the gold conversion that Nixon eliminated, running deficits, and then also encouraging Arthur Burns to keep rates low, which he did, which, you know, basically means that he's widely viewed to be, you know, if not the worst, one of the worst Fed governors in history. You know, we'll see how history ranks Bernanke and Yellen. Yellen, I think, also, you know, in her roles in Treasury, she termed out the debt terribly, and they just did not do enough to maintain a stable currency. You know, this arbitrary 2% inflation thing, and then you understate true inflation, and it's horrific. And what that means is that anything that looks like a hard currency or something like it, where there's a finite supply, and for us that's Bitcoin. On the crypto side, I mean, that's not to. I'm not trying to, you know, talk down any other cryptocurrency, but the fact is, Bitcoin is to crypto as gold is to precious metals. Right? It is the reserve crypto at the moment. So I would leave it at that. Tucker D Dog says hedging can trigger constructive sale tax rules. Yes, that's true. And the constructive sale tax rules. So again, you need to look at each of your own situations. There's another situation that can arise is if you have spreads on, can the cost of one be offset against the premium of another for tax purposes? And the answer to that question is not. You know what? And I have to tell you, one of the things that really upsets me about this is that, you know, there are over-the-counter structures like variable prepaids and things like that that at the very least can defer taxes, and they're much more costly to investors than using listed options and effectively creating a synthetic that replicates those same strategies. It isn't fair from a tax perspective, but it is what it is. We just have the misfortune of having to live with it now. And the interesting thing too is that if you have a tax deferred account, so what do you do in a tax deferred account? Well, it's not going to have a tax implication, but you might still want to do something like this just on a raw trade basis. You know, if you have the stock and you don't sell the stock, but you buy the put, you've given yourself a synthetic call. No tax implications necessarily, but, you know, that's something to think about. So yeah. Would tokens exuberance be a barometer for Nasdaq at some point? I guess my question is, are you talking about the stock NDAQ, whether or not this is going to be bullish for them? I guess my question. You know, these guys, they're making all of their money on market data. The exchanges had gone to the SEC and asked for permission to raise market data prices. I think it was about a year ago, so maybe somebody can look this up and double check. But it feels to me like it was about a year ago. They got turned down. But they will get, you know, they will get further increases, and, you know, it's a great business to be in for them because everybody's got to subscribe to the market data. You can't run a brokerage firm and say, oh, well, we only have some of the market data available for you. You know, it's kind of a stick-up job. So they are a regulated utility, but a utility nevertheless. And, you know, the more people use the data, and that seems to be a one-way street, the better it is for them. You know, any and all trading activity in this and every other instrument definitely works in their favor. But I actually had hoped I was going to have an opportunity. I have some friends who work for the exchange. And, one friend of mine that I've known for a very long time, he's been with the exchange for decades now. He was actually a market maker once upon a time on the Philadelphia Stock Exchange as well. Unfortunately, he was not there when I stopped by their their offices on. Well, let's just take a look at this. Again, get rid of the price. This is the only thing that's a little bit nettlesome, right? So we have the same. This is, look, this is not just unique to Nasdaq, but wow, almost 40 times forward earnings. We're getting up there. We're getting up there in a lot of things. That's always going to be the case when we're at all-time highs. But this is a situation they do operate in a regulated space. Are they going to be able to increase their fees? Does it materially increase their costs? No. But you just can't turn the spigots on 100% because it is regulated, right? So increased trading volumes, more product, demand for data, all good tailwinds. No incremental costs. It's not like they have to build new factories to generate it. Pretty handy in that respect. But that's ambitious where we're at right now. I'd probably be, at the very least, overwriting this if I had a position there. So PC is asking, could you look at 50% MSTY and 50% winter, how this is basically a play on vol? Okay, so that's an interesting take. So for those of you who don't know, these are both short options strategies with a different directional bias. So if I guess a 50-50 portfolio, I guess you're thinking then, and you can just confirm this for me, I'm guessing that your thinking is that you're just looking to be short vol in the complex and not take a directional bet. So that would get you, in this particular case, we're looking at, 4 months, not even, and you'd be up 10% if you had that pair on. Now, here's something interesting to think about, right? If you do a trade like this, it isn't set and forget. And it isn't set and forget because think about if you had put this on back at the tail end of March, a day before my sister's birthday, as it looks like. It looks like that was their first trading day. What has happened, right? So the winter ETF's price is now down 40%. MSTY is flat. Total return of 36% in one, and total return of negative 25.62% in the other. So you're up about 10%. Great 4-month return in terms of yield, but you're out of whack balance-wise, right? So you have to give some thought to rebalancing. Very simply, if I put $100,000 into this, I'm basically going to say that MSTY's unchanged in this example, so I would actually have 50,000, but I'm down 40% on the other side. So at this point, I'd be long 30,000 winter and 50,000 of MSTY, and I'd have also taken distributions. So it's a creative play, but you do need to rebalance it so that you don't get way out of whack. I mean, imagine if this continues for another quarter, so that winter drops another 40%. So it's going to be 40% off the current 60, which is really 24% off your initial, right? Call it $12,500 Why not? Just keeps the math easy. So now instead of having the 50,000 that you initially had, or the, you're down 20 on this thing, so 40 now another 12.5, so now you're down to 27,500 on one, and versus, you're basically going to have half the amount in winter that you do in MSTY. So you have to, if you're going to implement a strategy like that, you have to give rebalancing some thought. Now you're going to be taking distributions, but one other thing to think about, which is that now the total return here on winter, because actually you've been taking distributions, so it's really this price change thing that you have to think about. So you're going to have to take some of those distributions and reallocate them to the underperforming asset to maintain a balance through time. And I guess you could do that with every distribution. That would be one way to play it. It's an interesting take. Of course, you know, if you're watching this live stream, my guess is that you probably do a decent bit of options trading yourself. And, you know, you could also consider, you know, selling call spreads in one and put spreads in the other as a yield play, you know, with somewhat limited risk on each side. But it's an interesting take. I'll take a closer look at that, because I actually have to sort of model out the daily returns and think about how one might optimize a trade like that. But it's an interesting idea, and I actually hadn't thought of it. Should have, but I didn't. Okay, let's see. I saw something in here. Ah, yeah, there it is. That's definitely an interesting one. I see. Finwest, that Netflix trade was me. I told my broker to fill one contract at a time, not all at once. Finwest taking a $1.25 million long options punter for 2 trading days on Netflix earnings. This guy's playing for keeps. Very funny. Unless you're serious, in which case, when you come back to California, I think you can take us all out to dinner. If you can roll the cubes on a $1.25 million on a 2-day trade on a single stock, you can afford to take us all out to dinner. And you definitely can if Netflix rallies 10% after they report. Okay. Oh, whoops, I'm sorry, I'm missing something unusual. Second half of whose question? Oh, yeah. Sure. I apologize, because normally I have a lot of this stuff booted up. See, now I have to go to the authenticator. So, literally just got in from... I have to pull up my authenticator app now, because I've been traveling, and this thing logged me out. Which authenticator app was I using? Nope. So, how many digits is that? 6? So this is not the right authenticator. So normally I would be able to bring it up, and you can see that I use 2-factor authentication for almost everything, but because I've been gone for 2 weeks and shut the machine off, everything has to be booted back up, and we just got everything hooked up. So, all right, that'll be Friday's business, I guess. I will pull it up on UnusualWhales. My authenticator, your connection was lost. Okay. My mistake. I should have had that booted up already, but we were kind of scrambling here to make sure everything got plugged back in again. Okay, J-Bow says, how long would you wait before investing in UNH, United Health again? I'm thinking of buying the Jan 27 354.10 call spread financed in part with selling near-dated 260 puts or bull put spreads. I do like that trade. I think there's a lot of bad news priced in, but do bear in mind that there is one, you know, the big unknown is this, you know, the Medicaid fraud investigation. If that goes anywhere, that could be really ugly. But like I said, there's a lot of bad news priced into this thing. I mean, this was a name that was trading 30 times, justifiably so. And now take a look. I mean, here we are. It's trading 14 times full year. This is, you know, this thing is really quite cheap compared to its own history. I mean, and they've got the right management team coming back to try to fix things. So, what are we looking at here? For next year's numbers, we'll just call it 292.5 on. I'll round up and call it 25. I mean, less than 12 times forward. for United Health. Same management that turned the company into a success in the past. There's a lot of that's a lot of bad news priced into the stock. So I like that, and yeah, and I kind of like buying the longer dated call spreads. That's all right. That's a decent trade. I think let's take a look. Is this thing? It really does seem to have sort of found a level here, doesn't it? I mean, this thing is back at 5-year lows. So let's also think about this, all right? So let's assume this is a fair price for the stock, okay? And let's assume that they don't go back to the gangbusters years that they had. Let's just posit that the company never regains its mojo. What would be a reasonable turn? Well, if it can match S&P, revenue and earnings growth, not go back to what it had before, then what you would be looking for, let's just say 20 times. So let's just do that math. We'll call it $300. That's $15 a share. Let's see when it was last doing that. When was it last earning $15 a share per year? Yeah, 5-6 years ago, right? And then, this was during the pandemic period. Payouts almost certainly went a little bit higher, and they still made $16. And that takes us back to where the company was under the existing management. So the CEO had been replaced. We had the new guy come in. I think it's, I don't know whether this was part of your calculus or not when you started to think that this might be an interesting level to get here. But I think it is very interesting to me that the stock is kind of seems to have found a bit of a footing here, which suggests to me that some institutional holders are sort of staying put at these levels and not bailing out. I will say, though, that, and this is just worth mentioning, that money managers don't like to have big losers on the sheets at the end of reporting periods. It's not a good look. People are saying, "Oh, well, how'd they do this year?" And they look and they're like, "Oh, United Health was a really big holding." You kind of feel like if it's a big position now, it automatically got smaller, right, as the stock price fell. But you can see a little bit of additional weakness. So if at the end of the year you're getting any kind of a Santa Claus rally and this thing is not really finding its footing, it's probably not going to. And that may very well be the reason, is that there are a couple of folks who are all sitting in the same, they're looking at the same data we are, and they're thinking, okay, this thing's awfully cheap here. Shouldn't take much for it to start getting a bounce back. But if you start getting close to the end of the year and this is still lingering on people's sheets and it hasn't caught a bid, my expectation is it's probably not likely to going into the end of the year. That doesn't make it a complete disaster, and by itself it's not a reason not to own something, but just measure your expectations accordingly if that's the case. But I do, I've said it many times that I was always very impressed by this company for many years. People who know more about the business than I do followed it very closely, and one of them went to work there. But government fraud is a ticklish issue, so that's not something we can completely ignore. Okay. Interactive Brokers reports on July 17th, bought the 670 call vertical, September expiration, also sold the 55 puts. Your comments? Like that, with one observation. Now, the fact that you bought a call vertical certainly helps. But here's the one thing I would say, and that is that you're going out 2 months. there is going to be a bit of a vol crush. If you had something like a call spread risk reversal, which you do because you're selling near, you did say that, yeah. So you're selling in near dated puts. That's fine because you're short 2 options, you're long 1. But I just want to make this one point. So if you can see where my cursor is, that's their next quarterly earnings result. So when we're thinking about the vol crush, there's no natural bid other than the expectation that the street often has that we tend to get a September and October, and actually most people think of October as being a more volatile month than some others, which is true. But September is actually quite volatile. So all else equal, own September, short August, so basically own the switch over Labor Day. I like that. But I would just make the point that you're kind of in a place where Vega can hit you a little bit. It's okay because you're short August puts and you're short the wing call in Sep, but it's something to think about, that if you wanted to create a longer term bid in vol space for the call that you're long, and I'm not trying to make things overly complicated, so you're going to buy something that expires beyond October earnings, which are estimated to come out on the 15th, and then sell the other 2. But that's a little bit like those strangle swaps we sometimes talk about. Actually, what's the implied move here? This is an important element. It's a little early still, but let's see here. We got 5.3 versus a 3% average, down 8 recently. The 55s is down about 8%. Okay. What do the technicals look like here? All bullish, so you're definitely on the right side of it technically. Not a single sell in the top 10 best performing technical indicators. That's interesting. So yeah, okay, I like that. Oh, PC, yes, I have said. Oh, so I thought you were talking hypothetically. PC does. I guess you were not talking hypothetically. You actually put this trade on, or are you just putting it on and you're leaning long based on favorable MicroStrategy Bitcoin? I guess it doesn't really matter. Yeah. Okay. Yeah, this is really interesting. I'm going to take a closer look at that because it's just not something I've examined. I have to kind of work through it a little bit in my own mind. Now, I want to just throw something else out there, and this is, look, I think that all of these options-based, I ran an ETF, and the expense ratios for options-based ETFs, I mean, I find that it's pretty interesting. They're very reasonably priced because even just running a long-only mega cap ETF, there's a lot of fixed expenses. So if you've got, call it a 95 basis point expense ratio, that's well justified. And if you have an options-based strategy, that's even more. But if you start stacking up a lot of ETFs and sort of some interesting structures, those are also things that you want to sort of bear in mind. Like how do the fees play into this? How does slippage play into it? And so that's one of the things I'm going to have to work through a little bit as I examine that. But that's an interesting exercise. I'm going to mention it to Mark Guthner too. He might find that very, very interesting. The view queue, oh yeah, there we are. Okay, Anil, what's your opinion on Apple exercising the 210 call position this week? Looking at their recent deal, MP, okay. Just very quickly, are you talking about exercising a call option? Is that what's going on here? So I'm assuming you have a 210 call that expires this week, and you're assuming that you're going to exercise it because it's in the money, although only barely as of today's close. So we'll see. If you're asking me, you own a longer dated call, should you exercise it? I'm assuming you're not asking that, but I'm going to say something here just in case. All right? We don't exercise options early except under very rare circumstances. And if you... let me go back. View all. Yes, I have. Okay, so you have the 210 calls that expire at the end of this week. So I think, you know, we're coming up on an hour, but I do want to leave everybody with this one thought. This is just a general guideline, okay? You don't exercise calls early except in very, very rare circumstances. And I'm assuming that most of the people that are watching this live stream, you know this already, so I'm not going to, you know, I'm not going to get into it too deeply. What are the circumstances where you exercise calls early? And some of these are not situations that most self-directed investors are likely to experience. You exercise calls early if the extrinsic value of the call prior to an ex-dividend date is less than the net present value of the dividend you would forego by not exercising it. So it's an in-the-money call option. Stock's about to go X. There's almost no extrinsic value in that call option, and you want to own the stock to collect that dividend because the dividend is greater. Because the stock will go down by the, all else equal, the stock will drop by the amount of the dividend on the ex-dividend date. If you own the shares, you get it. If you own the call, you don't. So you would rather own the shares in that case. Not a common situation, and if you have doubts, the best thing to do is to sell it before the ex-dividend date so you don't have to tinker with that. What's another reason you exercise an option early? So if you're going to exercise a put early, this is more commonly something that a market maker would have to experience, and it's kind of, it's related on a carry cost basis. That is when you're long puts in stock. So I'm long the stock, and I long the put, and now the put's deep in the money, and so I've got a lot of carry in this case, right? I would rather have the cash because I could be earning interest on it. Now the interesting thing here is that that put could be theoretically an early exercise, but it's less critical that you know, that you understand that. And the reason is because there's not a discrete event like an ex-dividend date. Every day you're kind of bleeding away. You're forgoing interest that you might otherwise be collecting. And you don't want to do that over a long period of time. I mean, if you own stock and you have deep puts, you have no delta. You're not going to make money because the stock's going up and down, and you're foregoing interest. You don't want to do that. But if you give up a day's interest because you didn't recognize the situation, that's not the end of the world. If you forget to exercise long calls before a big dividend date, that is a much more important and critical miss, because once it's X, it's X. You can't correct it. 1 day's worth of interest, that's probably not make or break. But if you've got a stock that pays a 4 or 5% dividend, then screwing that up by 1 day will cost you 1%. And that is material. So, and I think it's probably not likely that many of you are long big blocks of stock and deep in the money puts. That's something that's much more common in the market making world, and it just happens over the course of time because you have a lot of open interest. You're trading in and out of stuff. And actually, Paul Wilmot of the Wilmot Forum did one of most complicated lectures I have ever seen about optimal early exercise of puts at the Courant Institute of Mathematics at NYU back in, it was like 25 years ago. I went to this lecture, and he was like, oh, we're going to talk about how and when you should exercise puts early. And I was like, oh, what is this, inane and simple lecture? Paul Wilmot's supposed to be an options genius. And for the first 15 minutes, I thought this is just, way too simplistic. And then for the next hour, it got so insanely rocket science mathematical that I was utterly blown away. It had a lot to do with the nuance of virtual optionality, and it was just insane. So if you really want to get into the weeds, Paul Wilmot's your guy on that, but I doubt those are positions you guys would really hold. Okay, since I've chewed up an hour and we're getting a little bit too wonky probably at this point, I think that's a good place for us to sign off. Thank you guys who stuck around, and I apologize because of all of my travel for the live streams being a little bit more disjointed and doing these things on the road. But I want to get the content out there and engage with you. Oh yeah, so just on to Yeah, if I'm in your shoes and you want to own the shares, sure. And if these things are in the money, I mean, look, if the stock rallies another couple percent, and you want to own the stock anyway, then just let them expire. They'll auto exercise and you're good, right? So yeah, that's totally fine. I don't have an issue with that. And with that, I hope you guys join us for office hours, and I'm hoping I'm going to find a suitable internet connection at whatever hotel I'm in that will be able to do that. And until then, like, subscribe, notification bell, and thank you all very much for watching.